Welcome to the deep dive. We are here to transform abstract numbers into concrete power.
hmm
Today, we are undertaking a deep dive into the financial bedrock of any successful venture.
Right.
We're answering the single most consequential question you can ask when you launch a product, start a business, or even just propose a project.
And that question is, how much do I actually need to sell to make a profit?
And maybe more importantly, what happens if I don't?
That is the whole point of cost volume profit analysis, or CVP. If you're a decision maker, you can't ignore this.
It's not just theory then.
No, not at all. It's the manager's reality check.
Hmm.
It's your financial compass. It tells you where that line between survival and failure is long before you spend a single dollar.
Okay, so to make this really practical, let's just jump straight into a classic case from our sources. It's the charity banquet case from 1985.
A great example.
So you have this big nonprofit, they're planning a huge fundraising event, and for them, losing money would be an absolute disaster.
And they had really clear numbers to work with. They planned to charge $250 a ticket.
Okay.
Their variable cost, so the cost that it changes per person, which was mostly the caterer, was $40 per head,
And the big one?
the big one.
Right.
They had this centerpiece attraction, an $18,000 car prize. And that was a fixed cost. It didn't matter if 10 people came or 500, they had to pay for that car.
Okay, so let's unpack that. The very first step, really the engine of this whole analysis, is finding what's called the contribution margin, the CM.
Right. And this is not your total revenue. This is about what each sale truly contributes to covering those huge fixed costs.
Right, that $18,000 car.
Exactly. For every ticket they sell at $250, 40 of those dollars immediately go out the door to the caterer,
So the contribution margin is $250 minus that $40.
which leaves you with $210. That $210 per person is the only money available to pay for the car and any other fixed overheads.
And now we can use that CM to find the break-even point, so the absolute minimum number of people they needed to sell tickets to.
The formula is simple. You take your fixed costs and you divide them by the contribution margin per unit,
So $18,000 for the car,
divided by that $210 CM.
which gives us 85.7 attendees.
Right. And since you can't sell a ticket to 0.7 of a person,
They needed 86 paying guests.
exactly, 86 people just to break even. And just like that, a vague financial worry becomes one single concrete sales target.
That right there shows how powerful this is. But it brings up a paradox, right? If the math is so simple, why do so many smart, successful entrepreneurs just skip it?
Yeah, they really do. Our sources call this the natural optimism problem.
Okay.
There's this inherent conflict between the sheer enthusiasm you need to launch a business, that this is amazing, it has to work,
Yeah.
feeling.
And the cold, hard reality of the number.
Precisely. CVP is the discipline that forces that optimism to kneel before the arithmetic.
You hear the excuses all the time, right? Numbers are boring, or my favorite, I have great business intuition.
And those are the silent killers of startups. It's what the analysis calls the Ramona paradox.
Ramona Par-
Yes, you have a few outliers, the Ramonas, who succeed through sheer luck or incredible timing. But for most businesses, that unchecked optimism leads to failure because they just run out of money before they hit break even.
A break-even point they never bother to calculate in the first place.
Exactly.
So let's give you a framework, a checklist of 4 essential questions you have to answer before you commit any real money. First, what are all of our fixed costs?
Rent, salaries, insurance, that car price.
Yeah.
List every single one.
Second, what is our true contribution margin? Not just the price, but price minus all those variable costs. Materials, shipping, commissions.
Third, what's the actual break-even point? In units sold and in total revenue. That's your survival number.
And fourth, and this is the big strategic one, is this even realistic?
Right. If your math says you need to sell 500 units a month, but your entire market is only 400 people,
The math just saved you from a catastrophic failure.
Now, before we can really trust these calculations, we have to get the cost categorization right. This is where the foundation gets really wobbly.
If you mislabel a cost, the whole thing falls apart.
Absolutely. So let's just nail down the 3 cost behaviors. First up, you've got variable costs.
These change in direct proportion to how much you do.
Exactly. You sell one more widget, your raw material cost goes up by the cost of one widget. Simple. The key here for a manager is to control that cost per unit.
Okay, then you have fixed costs. These are the static ones.
Right. They don't change whether you produce 100 units or 1,000. Think of your factory lease or your annual insurance premium.
But there's a catch there, isn't there?
There is a really important one. Fixed costs are only fixed within a relevant range of activity. Meaning, if your factory's at 50% capacity, your rent is fixed. But if your sales double and you suddenly need to lease a second factory, your fixed costs jump up to a whole new level.
So they're not fixed forever, they're stepped.
A perfect way to put it. And finally, you get the tricky ones. Mixed costs.
Like your utility bill. It's got a fixed service charge, but then you pay more the more you use.
Yes. And to do any real CVP analysis, you have to break those two parts apart. This is where it gets really interesting.
How do you do that in a practical way?
Well, the easiest way, the one detailed in a lot of our sources, is the high-low method. You use your past data to isolate the two components.
Okay, let's walk through the utility cost example.
Sure. So you look back at your records, you find the two extremes. At your highest activity level, let's say you produced 10,000 units.
And that month, your utility bill was $5,000.
Right. And at your lowest level, maybe you only made 2,000 units and the bill was $1,400.
So you have a high point and a low point.
Now you find the change. The difference in cost is $3,600.
$5,000 minus $1,400.
And the difference in activity is 8,000 units.
10,000 minus 2,000.
You divide the change in cost by the change in units. So $3,600 divided by 8,000 units gives you a variable cost of 45 cents per unit.
Okay, so that's the usage rate. Now we just need the fixed part.
Simple. Take the high point. Total cost was $5,000. We now know the variable portion of that was 10,000 units times 45 cents, which is $4,500.
So you subtract that $4,500 from the total $5,000 bill.
And you're left with a fixed cost of $500.
Wow. So that messy utility bill is now two clean numbers. A fixed $500 charge you have to cover, and a 45-cent variable cost for every unit you make.
And that is the kind of detail that separates guesswork from real strategy. It's the foundation for everything else.
So now that we have our costs sorted, let's talk about the CVP toolkit. What can we do with these numbers?
I like to think of it in 3 levels, based on what a manager is trying to achieve.
Level 1 is just survival.
Yep. That's your basic break-even calculation. What's the absolute minimum we need to sell to cover our costs?
Level 2 is target profit. I don't want to just survive. I want to make, say, $50,000.
Right. So you adjust the formula. It's fixed costs plus your target profit, and then you divide that total by your CM per unit.
You're basically treating your desired profit like another fixed cost you have to cover.
You are. And level 3 is where the real management kicks in. Strategic change analysis.
The what-if scenarios.
Exactly. What if we invest another $2,000 in advertising? How many more units do we need to sell just to justify that cost?
Or what if we spend more on better materials, which raises our variable costs, but maybe lets us charge a higher price?
CVP lets you calculate the precise impact of each decision. It lets you compare scenario A to scenario B using hard numbers, not just gut feelings.
And tied into all of this, especially survival, is the margin of safety.
This is such a critical metric. It's simply your actual sales minus your break-even sales.
It tells you how much your sales can drop before you start losing money.
That's it. It's your buffer. If your margin of safety is $500,000, you can sleep at night. If it's $5,000, you are walking a tightrope.
It's a psychological buffer, really.
Yeah.
So, knowing all this, what are the big pitfalls people need to avoid?
Number 1, hands down, forgetting some of your variable costs. People forget shipping, payment processing fees, royalties.
And if your CM is wrong, your whole calculation is wrong.
Totally. Second pitfall is hidden fixed costs. People remember rent, but they forget the quarterly software subscription, the city permits, the accountant's fee. They add up.
And the third one.
Underestimating the time it takes to break even. Most businesses don't hit it in month 1, or even month 6. You often need to plan for a 1 to 3 year cash runway to get there.
Okay, so let's synthesize this. We've got a 7-point manager's decision checklist for you. 1, list every single fixed cost.
2, list every variable cost per unit. 3, calculate your exact contribution margin.
4, what is that break-even number in units?
5, the big reality check, and you actually sell that many.
6, how long will it take to get there? Plan your cash flow.
And 7, what is our margin of safety? Know your buffer.
All right, now let's get into the really strategic stuff. CVP isn't just about survival, it's a weapon. Let's talk about the reality for most businesses, which is that they sell more than one product.
Right, the multi-product reality. Think about that Major League Soccer stadium we mentioned earlier.
They sell tickets, concessions, merchandise, parking.
And each one has a totally different contribution margin. A ticket might have a $20 CM, a soda maybe $5, and a jersey could be $15. You can't just pick one of those numbers.
If you try to cover a stadium's fixed costs with a $5 soda margin, you're gonna fail.
You're going to fail fast, so you need to do a sales mix analysis.
Which means calculating a weighted average contribution margin.
Exactly. You look at your data. What proportion of your sales comes from each category? Let's say 60% of your revenue is from lower margin tickets, but 30% is from high margin merchandise.
You create a weighted average based on that mix.
You do. And that becomes the single CM number you plug into your break-even formula. It averages out the profitability of your whole business.
And the insight there is huge.
It's massive. The goal isn't just to sell more of anything. The goal is to strategically shift the sales mix toward your highest margin items
Sell more jerseys to boost that weighted average.
and get to break even faster.
Okay, speaking of high-stakes environments, that brings us to operating leverage.
A more advanced concept, but so important. It's basically the degree to which a company relies on fixed costs in its structure.
And Major League Soccer is the perfect case study in high operating leverage.
Absolutely. Their costs are dominated by massive fixed costs. The guaranteed player salaries, stadium leases, these are non-negotiable.
And the result of that high leverage is volatility.
Extreme volatility. If sales go up just a little bit, profits can skyrocket. But if sales dip even slightly, the losses are catastrophic.
Why is that?
Because once you finally cover that giant pile of fixed costs, that's say $100 million in player salaries, the contribution margin from every single extra ticket sold falls almost straight to the bottom line as pure profit.
But until you hit that point, you're just digging out of a hole.
A very deep hole.
Yeah.
And MLS really struggled with this at first. The CVP analysis showed them they had to radically lower their break-even point to survive.
So what did they do?
They systematically attacked the problem. They put controls on player salaries to manage that huge fixed cost. They started building their own smaller soccer-specific stadiums.
Which gave them control over other revenue streams like parking and concessions.
Right. So they lowered some fixed costs and simultaneously worked to boost that weighted average CM. The result was a structurally lower break-even point.
A more stable business.
A much more stable business. And that's how CVP turns numbers on a page into billions of dollars of enterprise value.
It really all comes back to that core lesson, doesn't it?
It does. Successful managers have to combine that entrepreneurial optimism with a relentless dose of financial realism. Businesses don't fail because they have no sales. They fail because their sales don't cover their costs.
You have to ask the hard questions before you commit the money. CVP is the tool that turns that feeling of anxiety into the clarity of a single actionable number. It tells you if you're headed toward profit or straight toward a cliff.
And to leave you with one final thought, let's focus on that margin of safety. Think about your own venture, a side hustle, a project at work, even your personal finances. Life is volatile. Markets are volatile. If your revenue or your salary or your effort suddenly drop by 20%, what is your personal margin of safety? Use this framework to figure out that precise numerical threshold you must clear every month before real panic, real structural loss sets in.
That knowledge is control.
Go calculate that buffer.